Hello everybody and welcome to trendrecognition.com. My name is Alexander Nikolov. I've prepared a short video presentation for you titled The Stock Market and the News Impact. In this presentation, I will discuss what the people believe about the news impact on the stock market prices and how actually does news impact the stock market. And at the end, I'll briefly discuss the medium-term prospects for the US stock market. So, what do people believe about the stock market? Well, most investors believe that news stories drive the stock market. Most of the investors, actually almost 95% of the investors, believe that when you have an uptrend, in order for this uptrend to reverse and downtrend to begin, you need to experience some bad news. And when you have an ongoing downtrend, a prolonged downtrend, in order for this downtrend to stop, to form a bottom and a new bull market to start, you just need some good news. But actually, this is not the way the market behaves. Actually, it's quite the opposite. The market behaves just the opposite of what I've just described. And as a result of this, most of the investors actually lose money most of the time. How does the news actually impact the stock market? Well, this impact depends on the stage of the market trend. In an uptrend, bad news stories lead to short-lived dips that are usually bought. You have some selling pressure after some bad news, but then the market resumes its prevailing uptrend. And if you have good news during an uptrend, this good news just brings some upside acceleration most of the time. What about the top? At the top you have plenty of good news that just brings sell-off on the market. The market sells off amid good news, which bring optimism, extreme optimism on the market. In a downtrend, bad news brings downside acceleration most of the time, and good news, they bring some short-lived rallies, but those rallies are usually sold off eventually. In a day or two, those rallies usually last a day or two, or a week or two, or a month or two, but eventually they are sold off. At the bottom, to find a bottom, you need extreme pessimism. As a result, to have extreme pessimism, you need plenty of bad news, and finally, this pessimism is bought by the market participants. So as you can see, it's quite the opposite of what most of the investors believe regarding the influence of the news on the stock market prices. Let us look at some recent examples. This is the chart of S&P 500 since the beginning of the year, and you can see in this area here in mid-January that the market formed the top after several good earnings reports from major companies, and then the market sold off heavily into first week of February, when it marked a solid short-term bottom. How did this bottom arrive? Well, this bottom was found amid fears that Greece, the problems in Greece would drive the whole financial world down. And the same happened again in at the end of February, when the market made another temporary bottom and then rallied strongly in March and April. And in most recent days, if you recall, last Monday, on April 12th, I believe, was that there was some bad news, disappointing results from earnings results from Alcoa. The market gapped down, but as you can see, it quickly recovered and made new highs. And then last Friday, there were several good earnings reports from Google, General Electric, Bank of America, And all of those companies were sold off, and the market sold off. And during the day, a bad news came that Securities and Exchange Commission investigates Goldman Sachs on some fraud charges. And as a result of this, the market declined on Friday and this past Monday. But then, as you know, the market rallied strongly on Monday, Tuesday, and Wednesday of this week because, as what we've just discussed, during an uptrend, bad news is simply bought. So the market bought this bad news. And at the day of this recording, on Thursday, April 22nd, there was another bad news from Greece regarding the budget deficit, and again, the market kept down, but then it reversed and rallied nicely during the day. So you see, in order to find a top, you need plenty of good news, not a bad news, to find the top. And now let me very briefly discuss the medium-term prospects for S&P 500 till the end of the year. As you can recall, I'm looking for a big sideways contracting triangle here from year 2000 top. Wave A was the bear market here from 2000 to 2002. Then we had a bull market lasting up to the end of 2007. That was wave B. Then wave C that bottomed in January, not in January, but in March of 2009. And currently, I believe we are in wave D of this multi-decade sideways contracting triangle. And that means that I expect higher prices for the next year or so. Currently, for short term, the market is overbought on the weekly chart. The weekly oscillators are overbought, so that means that a short-term pullback should start soon. It can last a month or two, but eventually the uptrend, I believe, will resume later this year, and the ultimate top would not come until sometime in 2011 or even 2012, and only then the next bear market will begin. So these are my expectations for the S&P 500 going forward. I hope this video helps. I hope you enjoyed it, and thanks for watching, and I'll be talking to you later.